Welcome to Ferris Incorporated, low-tech market leader in industry F66157. My name is Juliana Badovanak. Today, I will be giving you an inside look into one of North America's most prosperous sensor manufacturing corporations. Ferris has started out strong, quickly identifying the benefits of being a low-tech player with an emphasis on capacity. After the last few years, Ferris has proved itself a low-tech market leader with more capacity than any other sensor manufacturer. Let's hear Ferris's progress from our top executives.
Welcome to Research and Development. I'm the Senior Lab Technician here at Ferris Incorporated, where we are committed to providing our low-tech customer base with reliable sensors at competitive prices. Over the past 8 years, Ferris has developed 3 competitive low-tech sensors: Fast, Furious, and our most recent launch, Freaky. Allow me to highlight for you management's strategic thought process. A key factor that needed to be addressed in order to be successful in implementing our chosen strategy was lowering our costs. Production management was tasked with increasing capacity and automation to a degree unparalleled by rivals. In doing this, Ferris effectively relieved a portion of our labor costs from staffing and overtime, raising profit margins significantly. Responding to market research, we realized that our potential customers were most concerned with the price of our product, which was 41% importance, and the age of our products at 29% importance. Here in research and development, we worked hard to deliver products that met the customer's criteria of approximately 3 years of age and a price point of between $15 and $35. As the ideal point in the low-tech sector shifted yearly, it was crucial for our R&D team to constantly be analyzing and repositioning our product to the optimal position in our customers' eyes. Our 2 initial products, Fast and Furious, were both released into the low-tech market early, giving them a chance to accumulate market share while the sector was still expanding. The deliberate release of 2 products very early gave Ferris a 2-to-1 product ratio over most of our competitors, who began with only 1 product or whose resources were spread finely across both high and low-tech sectors.
Yep.
Freaky was incorporated into our product portfolio within the past 2 years. Due to the lateness of entry, our management team knew that the growth within the low-tech market was deteriorating, so we would have to be very strategic with the product's positioning. We decided to introduce Freaky into the market on the very fringe of the low-tech sector, again using the overlap of high-tech and low-tech to our advantage, as our product would have ample time to gain market share in both sectors before drifting into low-tech completely. We are currently looking at Freaky as a fully low-tech product now that the perceptual map has shifted yet again.
Our intended marketing strategy throughout the simulation was to target and dominate the low-tech segment. The demand for low-tech products were much higher than those in the other industry, especially for the first 4 years. Understanding that price is the most critical element of generating a large volume of sales was pivotal in succeeding in this market. Therefore, we strategically set the price for our low-tech products just below that of competitors to gain greater market share since inception. Our low-priced products helped create a large customer base, therefore there was no need to invest heavily in the promo budget. However, it was key that we retained our customers, improved accessibility, and customer survey scores. Therefore, we allocated most of the capital into the sales budget to further improve one of our key performance indicators, which was our return on sales. We as a management team often use a very optimistic approach when coming up with a sales forecast number. This led to an increase in our total variable cost due to storage. After realizing this in later years, we then decided to produce far fewer products, which had led to stockouts. The intended change of strategy was to be able to forecast sales from a more worst-case scenario perspective. However, it was proved to be a difficult task. We have steadily become currently the market leader in the low-tech segment with a market share of 30% and a customer accessibility of 98%. In order to maintain this position, the incoming management must continue to monitor the pricing of the products, better forecast sales given market conditions, and allocate a steady budget in the promo and sales department.
Welcome to the Finance Department. Here at Ferris, we pride ourselves on our ability to utilize debt and equity investments to generate positive returns. Over the course of the last 8 years, Ferris has successfully leveraged both long-term debt and the issuance of common stock to fuel the growth of the company. Through a trend analysis of the debt-to-asset ratio, it is clear to see that long-term credit facilities have been used in various capacities throughout management's tenure, ranging from 33% in year 1 to a high of 59% in year 7. Management has made a conscious decision to pay off future debt in year 8 at 43% to reduce the risk associated with such a leveraged operation. Sitting at a ratio of 43%, Ferris is in a position to leverage further debt should the capital needs arise. The varied use of both credit facilities and equity financing can be seen in the debt-to-equity ratio, as this ratio has ranged from 49% to 142% over the past 8 years. Ferris is comfortably sitting at 76% in the debt-to-equity ratio. Despite the opportunity for further use of long-term credit facilities, Ferris's current ratio sits at an astounding 28-to-1 ratio. With an abundance of cash in the company account, Ferris may not even require further debt financing in the near future. Moving along, we are able to analyze the trends of ratios stemming predominantly from the income statement. The ratios dealing with the company's ability to generate returns off of funds brought into the organization have shown great fluctuation based on inaccurate forecasting and current debt obligations, as we can see in year 7. But we sit very comfortably upon the conclusion of management's 8-year tenure. With an ROA ratio at a historical company high, 12%, and an ROE ratio of 21%, asset and equity resources are being deployed in profitable ventures by the company. After bouncing back from a 3% ROS ratio, efforts across all departments, such as the early payment of long-term debts, were able to generate higher margins in year 8. As Ferris is now able to meet credit requirements easily, a solvency ratio of 40% in year 8, and are generating higher profits off of all sources of investments, I am able to confidently say that Ferris looks forward to stable, profitable years ahead.
Welcome to the TQM and Ethics Department. Not only do we seek innovations in sensors, we also invest heavily in total quality management, as well as human resources. As our company expands, it was vital that we improved our quality, and Ferris has delivered. Material and labor costs have been reduced through breakthroughs in just-in-time systems, CPI systems, quality initiative training, and Six Sigma training. Through our investments, we have achieved an 11.8% reduction in material costs and a 14% reduction in labor costs. Additionally, admin costs have been reduced a startling 59.37%, with our focus on benchmarking and is further streamlined. These lower costs have allowed Ferris to remain competitive in a highly price-sensitive market by reducing our cost base and increasing margins. Not only have we decreased our costs, we have also increased demand by being a socially responsible corporation, by engaging in UNEP green programs, as well as improving distribution channels so customers can access our sensors with increasingly ease. Due to our efforts in TQM, demand has increased 14.4% in the past 8 years, establishing the basis for Ferris's low market domination. Having such a promising TQM record, Ferris has achieved in 5 years what had taken the rest of the industry 8 years to do, and was able to capitalize on this advantage by using the capital to fund research and development of new products instead. Ferris's foresight had paid off and become a market leader in terms of quality management, allowing the company to provide the same great product for greater margins and competitive prices. In addition to quality, Ferris has also prided itself on being highly ethical. In a 6th year of operations, Ferris was faced with a critical decision to accept a multi-million-dollar deal based on dubious relationships of employees or to deny the chance of growth. Ferris made the hard choice, but the right choice. We decided to renegotiate the deal despite the loss of wide margins. Ethics quality remains the pride and joy of Ferris Incorporated. And future. Our first recommendation is a merger with Andrews. This merge would gain Ferris additional market share in low tech and begin to gain greater market share in high tech. We predict for Andrews to appreciate in value as investors will realize synergies. Diversification of product offerings and access to a larger customer base will allow for improved margin.
Andrews has the second greatest market share after us and is relatively dominant in the high tech. By merging, we'd essentially tap into a market that would be rather expensive to enter by ourselves.
The second recommendation is to buy back stocks to increase share price and increase earnings per share. This is possible due to the cash position that Ferris is currently in. By buying back stocks, our share price will increase along with earnings per share. This will improve our current share rating of BB to hopefully AA or AAA.
The final recommendation is to invest cash into automation and capacity. At this point, we have access to cash on the balance sheet. Our current ratio of 28:1 indicates the company is highly liquid and has the ability to further invest funds into automation and capacity. Our return on our investments will be seen as our labor costs are diminished and lower prices can be set to accommodate our customers without sacrificing margins.
The CAPSIM simulation was effective in giving us a glimpse into real-life business management. During the simulation, there were many challenges that arose from our decisions and the decisions of other teams. The first major lesson we learned was that of forecasting. After rounds that resulted both in large quantities of remaining inventory and stockouts, we came across an important tool. Looking at the progress of other teams in terms of capacity and products, we could estimate the success of our products against theirs. When the market demand was greater than the company's combined capacity, our forecasting abilities enabled us to maximize production and stock out for our sensors, even when they were priced at $44.99. Taking from this lesson, we learned that it is always important to forecast not only based on our own perceptual performance, but also on the strategies in place in the market. The second thing we learned was the importance to be first to take on new challenges. That was especially learned in TQM. The simulation gave us recommendations to max out TQM during the first half of the simulation. Based